Hi, I'm Todd Phillips. Welcome to Smarter About Taxes. This video, I'm going to go through a PowerPoint that I actually presented to my team because there's a couple unique retirement plan strategies that I want to address. And these are really for entrepreneurs, small business owners, real estate investors that either they don't like the stock market and want to invest in the stock market, or they need all the capital they have to continue to grow their business. So I would say, hey, great tax planning strategy. Let's start a 401k plan. The response I might get is, I need that capital to grow my business. There's a neat trick in here that can help you keep some of the capital. We're also going to talk about what to do if you don't like the stock market. So going right ahead, retirement plan strategies. Sorry that this is a PowerPoint all the way through. It'll help keep on track though, and help you kind of visualize some of the stuff. So moving on. There's the title screen. Why is it not moving? There we go. Here's our two planning ideas for these people. Number one, self-directed IRA. Number two, 401k loan. If you've never heard of either of these, you're in the right place. You're in for a treat. The first one we're going to talk about, self-directed IRA. The cool thing about self-directed IRA is you can invest in just about anything you want. So if you go to Charles Schwab, maybe they don't even know if they exist anymore. You go to your investment person, you say, I want to start an IRA. They're going to have a pool of maybe mutual funds for you to choose from, or index funds, or maybe they're going to have managed funds, or maybe they could have something really interesting like a target fund or something like that. And you can choose those, and you can just say, I'm just throwing my money in the market and I'm happy with that. A lot of people say, you know what, I don't view the stock market as my favorite investment vehicle. I want to invest in other stuff. You really might want a self-directed IRA. The second bullet point here is super important though. Some transactions are prohibited. So you want to be careful that what you're looking at fits inside the box of a self-directed IRA. You have to find somebody too that's going to be the custodian for your IRA assets. A lot of the big shops are getting into this because they like alternative investments, but some investment advisors or shops are going to say no to this. And then some people out there, I don't necessarily going to send you to them, but people that can set the whole system up for you and you run it yourself. So you really run your own compliance team. I wouldn't recommend that unless you're really comfortable with the rules, but possibilities are out there. So again, need a specialized custodian. These can have high fees. So if you're talking about investing a couple $1,000, this probably isn't for you, because the fees are going to eat through a lot each year, just keeping that account open. It's a self-directed account. Again, I'm not talking about one that's with an investment advisor. I'm talking about one of these specialized accounts. And there's more compliance and reporting, so just be prepared. You're going to have to do a little bit more work on that side. Prohibited transactions. I'm not going to go into a lot of detail here, but there is a lot of it out there, and I definitely want to recommend getting that detail before you start investing. But I'm going to give you the high points. Self-dealing means you can't invest in something that you really have anything to do with. So if you're a house flipper, you're like, I'm going to do a self-directed IRA and I'm going to keep flipping houses, but you're the one that's there managing the project, the flip, and you're the one that's getting it ready for sale. That's self-dealing for sure. Can't do that. You can't, can't be a business you have another ownership interest in. So you're like, I'm going to reinvest in my own company. There's some weird ways out there that people do. Just don't recommend it. Self-dealing in an IRA prohibits that kind of stuff. But even if you're like, you know what, I have a friend who's a house flipper, I'm going to invest in his deal. Probably okay, unless you're over there picking out curtains, painting walls, or you're going to be the broker on the sale or something like that. Don't mix personal and business with a self-directed IRA. Seen people get in trouble for it. You also can't get indirect benefits. No furnishing goods and service. And here's one that a lot of people get tripped up on: no collectibles. So if you're like, I want to do collectibles in my IRA, can't do a self-directed IRA. That's a no-no. Okay, they're all different kinds of accounts, though they can have different limitations. So how big can I make my self-directed IRA? Well, I've seen them with millions of dollars in them. So it's not a matter of very small limitations. Like you think of an IRA with a $7,000 annual limit. You can do lots of different investment programs with a self-directed component. So you can have a self-directed solo 401k. You can have a self-directed simple. You can have a self-directed SEP. Those put in tens of thousands of dollars a year. You can even have a self-directed defined benefit plan. I've seen contributions to defined benefit plans for a single owner entity in the $200,000-$300,000 range per year. Those are specialized things, and it's only practical when you have no employees or all of your employees are also owners. Then they kind of make sense too. I remember doing one years ago for a large physician group. Their only employees were the physicians, and they just had one physician group. Everybody was highly compensated defined benefit plan made sense for them. So there's situations in here you need to investigate, but there can be really high limitations to these IRAs. So you can put 10,000, 50,000, sometimes even higher numbers in them. The next strategy, this is strategy number 2, 401k loan. This is for the person that says, I need the money that I would otherwise put in. So this strategy has a cap to it and a limit, which I'm going to discuss. But there's a way here for you to kind of put some of the tax money you would otherwise give to the IRS and the state, and you can take that money and put it into an account and then take some of it back out, so that really your tax savings are going into the account and you're able to continue to use that money by lending it back to yourself. Okay. I apologize for the cheesy slides I stole out of PowerPoint, but whatever, they were easy to use and they're easy for you to read. Some of them are kind of interesting. So participant limitations, the limitations I was talking about, can borrow back 50% up to $50,000. So what I see a lot of people do is they are all dependent on how you set up the loan documents. So if you, or the documents in the 401k. So if you want to do this, you want to set up your own 401k, you have to talk to your 401k provider and say, I want to customize my documents. I want to allow loans, and I want to allow, in this case, what I'm going to talk about is multiple or re-upping my loans. So what I see people do is they've got 100,000 in the account. They borrow half of it back. That's 50 back to them. And then they have to make payments on that. But you can renew your loan according to the loan documents, like once a year maybe. So each year you go kind of borrow back up to that 50 grand limitation. So you can keep that 50 grand pretty much at work, even though you are making some payments over time on it. The beauty is, yeah, you're paying interest on that, but guess who you're paying interest to? Your 401k. So that can be pretty cool too, especially, this is outside the scope of the video, but especially if you can figure out, maybe it's a business expense the interest is. So, you know, that's not double dipping, but it's really maximizing that opportunity there. So again, this is great for small business owners or people who want to reinvest in their business. The benefits, I kind of touched on them, but you pay interest in your retirement plan rather than a bank. Your tax savings stays in the account until retirement. So if you're 40 and you do one of these and you put some money in this 401k plan that was actually otherwise would have gone to the government, that's going to stay in there and work for you in the background until you hit retirement age. Now, 401k plans, when you pay the distributions out to yourself when you retire, those are taxable, fully taxable. So the government's eventually going to get their cut, but you will have the use of it growing and adding to your investment account over all of those years. So it's a nice play to have, and it defers taxes down the road. Okay, no impact on your credit score and no restrictions on the money that you use. So if you want to invest back in your own business, or you want to invest in that flip, that fix and flip that you're working on, you don't have the restrictions that we had when we were talking about the solo 401k. Okay, what are the risks, pitfalls, limitations? It can be deemed a distribution subject to tax and penalties if you default. So if you think that this money might be at risk, like you might not be able to make the monthly payments for whatever term you set up, let's say it's a 4-year term, you know, you're paying 1/48 each month plus interest. If you can't make that payment, like money's so tight, this probably isn't a good idea for you, because if you default, the whole thing could be deemed a distribution with penalties and interest. Just don't do that if you feel like you're in a situation where you might need all of the money back, or you might default. Administrative fees, limited to 25% of taxable income, and highly compensated limitations. I went really fast through that. There's limitations to a 401k plan you need to pay attention to. Let's do the math. This is the most fun part, okay? Let's just say you just do this the first year. It's just you. You're the only employee, and you're going to plunk in the full max contribution. If you're over 50 this year, 2024, that's $76,500. You plunk into that account. Okay, and I'm assuming you're a Minnesota taxpayer like me, and you're getting gouged. No politics, just that's the lay of the land. Your tax savings, federal rate of 37% assumed, Minnesota 9.85% assumed. Total tax rate is 46.85 on those top dollars. So by plunking 76.5 into this 401k plan, you're saving $35,840. Okay, the downside to doing this is that you have to come up with 76,500 cash. So if your cash is really tight, again, may not be a strategy for you. But assuming you plunk in the $76,500, then you can borrow back 50% of it. Okay, And that number, that 50% number, remember the limitation was $50,000 or 38 or 50%. In this case, 50% is $38,250. It's the lesser of. So the amount staying in is $38,250. Okay, so you put the 76.5 in, and you can almost immediately, whenever the paperwork's done, take the 38,250 back out. So your total out of pocket, because you took it back out, is $2,410. Plus you might have some setup fees and costs. So a pretty cool way. You're only putting in $2,410 in an account in order to have $38,250 in there that's going to grow for you until you retire. So you're taking your tax savings essentially. So it's gone. It's out of your pocket. We call this a tier 3 strategy at my firm, because your money out of pocket, but you would have given that money to the taxing authority anyway. So you're going to take that money, you're going to put it in the market instead, and you still get to keep all of it but $2,410. Pretty cool strategy. When you run the math out, just doing some net present value calculation stuff here, take this for what it's worth, because every situation is different. You don't know how things are going to turn out, but potentially if you invested it, I think I used a 10% or 8% return, something like that. Your value in 10 years of this account, saying you do nothing else with it, $165,158. Tax due when you liquidate it, you have to pay some tax on that. $77,376. Your net benefit, $87,871. Your loan balance, I kind of just figured that you're re-upping each year. The net cash you're going to get to the taxpayer is $49,621. Okay, so that $49,621 cost you $2,410. So you got free money, $47,211. Again, take the math for what it's worth. That assumes that the benefit grows, that it grows in the stock market and all that stuff. But pretty cool strategy. It's a great way. It doesn't have as big of a, you can't put as much in it as you could in a self-directed IRA. And obviously you create a 401k plan, you can continue to put money in it, but you're going to be limited to that $50,000 a year deduction. Well, that's it. I'm Todd Phillips. This is Smarter About Taxes. Go to our website if you're not already there, where you can register, log in, and watch more videos for free and get more resources. Or you can go to our YouTube, see most of our videos there. On our website, you're going to have some other value add things. You're going to be able to contact me and other professionals too. It's free if you haven't already done it to log in. I have to give a quick disclaimer. I am a tax attorney. I'm not your attorney. You can't take this as tax advice, because everybody's situation is different. Every situation applies to the fact pattern different, applies to the law different. And you're not my client, and we're not doing a client engagement. If you're doing that, sure, you could rely on the advice. That's not what we're doing here. This is just educational. Please take it for that. Please seek out someone who knows what they're doing for each one of these types of retirement plans, should you want to execute one of these strategies. Thanks again. I'm Todd Phillips, Smarter About Taxes.